quick disclosure. Sorry, quick disclosure. I mean, I've not put it on the slide or anything, but I do own this stock for the last, I think, 2 years now, more than 2 years. Not made money, but still hoping that someday it will turn around. So, quick overview on the general insurance sector. So, I mean, the market, the numbers are all there on the screen, so there's no point me repeating it. But if we just look at the sort of market share gains for the private insurers as a whole and the growth they have seen over the last 10 years, they're actually miles ahead of the public sector insurers. So it's something similar to, I mean, the private share market gains that we have seen in the other sectors, wherever private and public are competing, be it banks, telecom, oil and gas, now insurance. So anywhere where there is a competition between private and public, it's generally private sector which comes out on top, and something similar is playing out here as well, which is reflected in the growth rates as well as the market share gains. So this is the sort of overall story. I mean, if you just want to be positive on the sector, then this is the story, that private market share gains. Now delving down deeper into the private versus the public competition, if you look at this split again, right? I mean, motor and health is 2/3 of the market. Within these two, health is the fastest growing segment, and it will continue to be the fastest growing segment in the future as well. Primarily because, as I mean, people economically sort of prosper. I mean, first they buy a car,
Uh,
then make sure that they're healthy, etc. So
Sorry,
health is
Ravi.
where
I
most of the
don't
action
think.
is. Sorry.
I just want to interrupt. Once I don't think we see the next slide. We are still. I'm still seeing the first slide.
Oops. Okay. You're still seeing the first slide, or
Yes, I'm still seeing the first slide.
okay.
Yeah, still the first slide.
Now?
Yeah, now we are on the second.
Yeah,
Thanks.
now it's okay.
Yeah, hi Ravi. Is it possible to start a presentation mode? I think we can say it a bit broader. Or...
It's now it's in presentation mode, but can you see the second slide or still first slide?
Yeah, I think I can see second slide, segment split. I can see.
Yeah. Okay. Perfect. Yeah.
Okay. Yeah.
Yeah. So this is the second slide. Yeah.
Okay.
So repeating myself. So motor and health is 2/3 of the market. Now the growth is primarily there in the health space. I mean, first people buy cars, then they want to sort of insure their health, and especially after COVID, the focus is a lot more on the health insurance space. So this is where the growth is, and this is where, I mean, it will sort of make or break the insurer who is in this space. How big a market are they able to capture in the health insurance space? Now, if you look at the overall market share, I mean, not segment market share, but the overall market share. So, I mean, the top 5 players are roughly 1/3 of the market. These are private. And I mean, even though public is like 40%, they're hardly profitable, which I'll come to a different slide. The top 5 players have gained a lot of market share over the last 10 years. And if you add Star into this, because Star is present only in the health space, it would be like close to 45% is owned by these top 6 players. And they have actually grown their market share in most cases, and most likely will continue doing so because the others are not profitable. And if people were following the Reliance saga, I mean, Reliance had to shut shop because they were selling at such low prices that their solvency ratios went below the government mandated numbers. Now, let me just, can you guys see slide 3?
No, it's still
No,
slide 2.
No, still in slide
I don't
2.
know why this is like this. Okay.
Uh,
Maybe now you
uh,
can.
Yes,
Yeah.
now
Yeah.
yes.
Next one. Yeah.
Yeah, now. Okay. Okay. So this is just an overview of ICICI's portfolio. I mean, it would broadly reflect the market, but yeah, motor and health would be the sort of key areas where they are also having a large presence. And historically, they have grown around 1 to 1.5 times GDP growth. So these are not strictly comparable numbers, so that I'm clear. I mean, they had acquired Bharti AXA, so the FY22 numbers include the AXA numbers as well. So it's not a pure comparison. But be that as it may, because even HDFC had a couple of acquisitions, they have sort of at least grown by GDP. And in terms of their profitability, etc., it's the sort of biggest player in the general insurance space by profit, by a huge margin, and to a lesser extent in the net earned premium space as well. Now, if you look at the earnings per share here, I mean, there are two ways how you can actually look at valuing this company. One is people generally look at the book value per share. which is currently 200. So at whatever 1200 rupees a share, it's at 6 times book. But it's been a very long time since ICICI General Insurance actually raised any money. So it could be argued that it should be or probably could be valued on a price to earnings basis as well, because the banks are valued on a price to book basis, even though there's an argument that the business models are similar. But HDFC Bank has historically raised money every 5 years, same with HDFC. But ICICI General Insurance till now at least has not been that case of raising any equity. I think management also has been confident of maintaining that 15-20% growth rates without diluting any equity. So if you look at it on a price to earnings basis, then they're probably at 30 times earnings. I think the FY23 EPS would probably be close to 40. So 20, it's actually, yeah, sorry, 40, yeah, 30 times earnings, which is probably okay. I wouldn't say it's cheap, but it's not that bad as well. Now moving on to the next slide. Again, let me just close it and open this again, sorry. Which is the main sort of two ratios that we look at in an insurance company, at least for a general insurance company, is the loss ratio, and then loss ratio plus expense ratio, which is the combined ratio. Now, this is how the company reports it. There are small differences in the way I have looked at it, in the way company reports it. So FY22, of course, it's pretty obvious the combined ratios were bad because of the COVID crisis. But the loss ratios here, which are around 70%, it's broadly been that way, barring the couple of quarters of COVID. It's been close to that 70% mark. Now, if I look at it on a comparative basis, because on a standalone basis, it does not really give much information. I'll just come back to this slide later on. So if we look at the loss ratios, right? Now, broadly, you could say that ICICI and Bajaj are in probably the tier 1 category. They're up there on top. And then the ICICI Bajaj up top, HDFC Tata, and then probably Star also in the lowest category. But that's because it's purely into health. So the claims ratios are lower. But when you look at the chart on the right, the expense ratios for Star are higher because it's a purely B2C business as far as possible. So the expenses ratios are higher. And
I think
HDFC,
just to cut you off, like we don't see the next slide. We are still on slide
again,
5.
no, let me just close my presentation, just open it again.
Now we see the loss ratio and
Stop
expense.
sharing. Yeah, now let me just, I think this is a recurring issue. Let me just stop sharing and share again. If I toggle between screens now, can you see the slide changing?
We can see your, you have two screens, I think, right?
Yeah, this is the
your-
presentation
Yeah.
mode. Presenter mode. Sorry.
Yeah, I think I'm on my laptop, but I've connected it to my screen. Let me just remove this.
No, you can just change it in the display settings. Just put it on. Okay. Yeah, on top right, left. Yeah, display settings. Duplicate slideshow. You can change.
I don't think it's working, but anyways.
Yeah, this is perfect.
Now this is fine, right? Yeah, and you can see me switching between slides.
Yeah, perfect. Perfect.
Okay, great. Okay. So the loss ratios, Star would have the lowest loss ratio primarily because it's it's only into health insurance, and the others are higher depending on the sort of market they are present in. But the drawback of being purely in health is that your expense ratios are also higher. The red one is Star. So the loss ratios are the lowest, but the expense ratios are the highest. So the combined ratios would probably also be somewhere similar to ICICI. And also, if you are a multi-line insurer, your risks are spread out over multiple segments rather than only in one segment. Now, ICICI, where it lost out historically is in the health space. That's the reason that you see that the expense ratio for ICICI, even though it was close to 26% or 28% pre-COVID, it's now close to 34%. Two reasons primarily. One, of course, the Bharti AXA acquisition. Secondly, they have now finally started focusing more on the health space, because they've actually lost serious market share in the health insurance space. And just moving, I mean, the just moving slide. So 10 years or 8 years back, their health contribution was around 25% by premium. It's dropped to 22%, even when health has been the fastest growing space. And you look at their market share, they've lost massive amounts of market share in the health space. So I think the CEO, I think Bhargav, has also now realized it. I think he's focusing on the health insurance space going forward. So this is the sort of play I'm also looking at, that, I mean, once the, I mean, agency setup and all the distribution setup is done for the health insurance space, this is what should start growing. And currently all the expenses are front loaded. So you do see some bit of EPS compression kicking in because of that. And hopefully over the next 2-3 years, once, I mean, the story for health insurance plays out, you will see much better numbers. And you'll see that actually all others except ICICI, they've actually either maintained or grown their health market share. And if actually include Star here, I think Star is like 1/4 of the health space. So ICICI has lost out on the health space, and that's the sort of weak point for ICICI as far as the insurance is concerned. I mean, the underwriting is broadly similar for most players. I mean, the loss ratios, I mean, there's not much variability. Star can be explained because of the portfolio, but broadly others are all close to each other between 70 to 75, which is fair enough. I mean, these two are high. Over time, these should probably move towards the 70% number. Then all of them would be in the 70-75 bucket. And the expense ratios, I mean, if you would probably aim to have a combined ratio less than 100, but in the case of India, the market is still not as stabilized as in the developed market. So it's, I mean, the historical numbers have always been close to 100%, but that is fine, I think, because the yields in India are also much higher than in the US and UK. So to some extent, even if you're able to maintain a combined ratio of say 100%, and you have a decent investment book, that should sort of ensure that you have decent ROEs. And ICICI, for example, is, I think, guiding for a ROE of 18%. It was earlier 20%, but now because of the, I mean, expenses for the Bharti acquisition plus the health insurance increase, it's now close to 18%. So it's gone down by 2% because of these two factors. But at a very, very macro level, I mean, just moving back to this slide now. So, I mean, their investment leverage is close to 4x. So, I mean, even on a very worst case basis, if they generate only, let's say, 6% returns on their book, so that's 24%. So that's, I mean, simply speaking, just a straight 24% ROE without doing any underwriting. Now, if the underwriting is even semi-decent, they should be at least getting 18% ROEs. That's assuming they don't further dilute any equity, which most likely they should not. So at a very macro level, if they're able to just maintain this 4x leverage and get even 6 to 7% returns, so that sort of takes care of their ROEs minus the underwriting numbers. So high level, that's the sort of investment philosophy or investment thesis that I have in mind. And secondly, the health insurance
Segment.
plays out. Now, I mean, I've not done a comparison with China and the US, etc., because it's not a surety that each country would play out the same way. But I had done some comparison with China a couple of years back. So the health insurance market in China is roughly 10x what it is in India. So basically, we are where China was 20 years back, I mean, in terms of the market size.
But also,
So-
in India needs health insurance penetration, right? Because our government infrastructure, hospital infrastructure is not the best, I would say. So having a private health insurance would give access to better healthcare for people, right?
No, I agree. I mean, health insurance, even life insurance. I mean, most insurances are underpenetrated in India. So I've not put that side back because that story is sort of generic for most sectors, but probably even more prevalent for insurance sector as a whole. So that story is there, that it is underpenetrated and it should grow, and it has historically grown as well. I think probably 2x real GDP, maybe 1.25x nominal GDP. So that story is there. Within this, health probably would grow at say 3 or 4x GDP, and your, I mean, slow sectors like maybe fire, marine, maybe would be at
Mhm.
1, and maybe motor would be at 1.5, but health definitely would be at least 2 to 3x your GDP growth. Now, the only point is, when do these things turn profitable on a steady state and stable basis? Now, I mean, last 2 3 years have been sort of a washout, so we really can't compare the last 2 3 years numbers. And this whole sector as a whole, I mean, it's not yet mature enough to look at 10-year numbers and do that sort of analysis. So hopefully in the next 10 years is when these things stabilize, and we can sort of look at proper comparison metrics. I mean, going
Uh,
10 years
uh,
back.
Ravi,
Could
I
take
have a
more than 10 years. Yeah,
Ravi,
please go on.
I have a question. This profitability, I think the
Hmm.
way this insurance company report profitability is completely different than other sectors. Because I understand
Yes,
ICICI and others, first 10, 15 years, they didn't earn any profit. Because I think it's
yes.
the way insurance regulatory has imposed regulations, how they report profitability. I couldn't get my head around it. But do you know how they report, what caused them to report loss for a decade?
So there are two P&Ls actually in a general insurance company. One is the shareholders P&L, and the other is the policyholders P&L. So the P&L from the policyholders flows to the shareholders P&L. So, I mean, as per IRDA guidelines, you cannot load all the costs onto the pricing of a policy. So, I mean, there are some guidelines on what all costs and what all limits you're allowed to load onto a policy. So I think I have it open. Let me just share that with you. I think I was looking at it. Let me just,
I think my
this
question
would
is
be a
probably
good
slightly
number.
different, right? If I see any, take an example, Edelweiss, where I'm invested,
Hmm,
they have been
hmm,
reporting losses for for a decade now, almost,
yeah,
right?
yeah,
And they say that they will report it for some more time. And I know ICICI has gone through, HDFC has gone through reporting losses for a decade, and then once they cross the inflection point, then the
yeah.
profitability comes. So what
Hmm.
profitability you see now is could be just a tip on the iceberg, because they spent decades making sure that everything is in place before they report a profit. Is that
True. So you
correct?
have to make
Uh,
upfront investment. That is true. I mean, that assessment I would agree with, that you will not see profitability for a long time. Now, ICICI has, I mean, it's beyond that threshold point. It has invested over the last, I think ICICI was one of the first players to get into this space in
Yes. Yeah.
2001. So it's been 20 years. So they have a head start.
Just to add
And
to this discussion, like just a quick point, which Pramod is also making on the chat, is we have to differentiate between life insurers and general insurers. And general insurance is a profitable entity because the contract duration of an insurance contract is much shorter than in a life insurance. So life
Okay.
insurance requires much higher provisioning or to build up loss reserves versus general insurance, because it rolls in 1 to 3 year time period, general insurance. So ICICI Lombard, like even if we go back in time, it has been profitable for a while now. Obviously, there are certain upfront costs to set up an insurance company, such as building people, process, and whatever. But generally, life insurance has a longer cycle with versus general insurance. And maybe Pramod can also add to it because he works in this sector, so he'll have more insights.
after my limited knowledge, I mean, a lot of analysts actually do not look at the profitability numbers for life insurance companies, since, like you rightly mentioned, that most of the profitability is, I mean, even in a long-term contract, the profit is actually the tail end of the years of the contract. The initial first few years would just go in paying distributions and the expenses. So rather than looking at a PAT number, which we are doing for a general insurance company, probably the embedded value would make more sense for a life insurance company. But anyway, that's a separate discussion between life and non-life. But in non-life as well, I mean, initially you would have X rupees of expenses, and that would be a fixed expense, you having an office, a distribution setup, agents, etc. And then that's broadly a fixed cost, and then you start selling and you will have a J curve of losses, and then you will be into the profits. But even accounting for all of that, I mean, in the last 5 years, it's the big, I mean, most of these barring ICICI, I mean, sorry, Bajaj, have got a good bank assurance setup as well. And it's only very recently that I think ICICI Bank took a call that they would not actively sort of push all the products of their insurance subsidiaries for both health and life and non-life. So that was also a bit of a headwind for ICICI, that suddenly they lost a big share of premiums from their sort of biggest bank insurance partner, which is ICICI. But I think now ICICI has started again slowly selling some bit of indemnity policies, etc. But I mean, long term, ICICI Bank would be the biggest sort of channel for general insurance, and they are now trying at looking at other bank insurance partners as well. Because I mean, end of the day, this is a push product. I mean, we may think of it whatever it is. I mean, motor is a mandatory insurance, so we have to take it. But I mean, unfortunately, it is still a push product. I mean, people generally don't want to go and take insurance without any return at the end. So it's still a push product. So the agency does matter a lot. But hopefully, slowly things will change and people will voluntarily look at buying your health insurance products. But yeah, Pramod, you can add. I mean, your sort of hands-on view on the sector rather than a top-down view.
I think Pramod's audio is not working, so probably he just commented on a comment. So I think that could be the reason.
I have like one question which I'm wondering if you have thought about it as to now what we see in terms of ROE profile of an ICICI Lombard. It's kind of in line with what HDFC Bank has been doing, kind of 16 to 18% ROE. In the past, it used to do 20% plus ROE, which has come down, and management has guided that it will be in the mid or high teens for the foreseeable future, because they want to build up their health insurance venture where they have lacked significantly, especially on the retail front. So I was wondering, like, why should ICICI Lombard trade at 6 times multiples on book value, whereas like HDFC Bank for everything is growing at similar, if not higher rates versus ICICI Lombard, and HDFC Bank is now at 3.5 times.
So that's, I mean, good debate, because like I mentioned, I think briefly. So, I mean, you're looking at it on a price to book basis, which is fair, but I'm looking at it on a price to earnings basis.
Okay, so even on an earnings basis, HDFC Bank is like 17, 18 times versus Lombard of 34 times. So why should I pay double multiple for something for which the growth will be very similar?
I mean, insurance is probably 20, 30 years behind banking in terms of penetration and the sort of stability. So if you look at HDFC Bank 20 years back, they would have been probably trailing at similar multiples. So you also need to see where they are in their space. I mean, HDFC Bank 20 years back is probably, I mean, a very rough back of the hand calculation would be like insurance of today, because insurance only got deregulated in 2001, where private players got in.
No, but if you look
even
at the market
for
shares,
the initial 5 years,
HDFC Bank has lower market share in lending versus ICICI Lombard, or let's say similar market share. So it's not like ICICI Lombard is a small company by any stretch of imagination.
But you should also look at the profit share. I mean, so yes, maybe premium share, HDFC, ICICI, Bajaj, there may not be much difference, maybe 8%, 7%, 6%. But if you look at the profit share, I mean, Bajaj and ICICI are like 2/3 of the private profit share. So
that makes it even more difficult for them. Like when you already half of the industry's profit, you're already a big giant. So how much can you get? Like how much can you get to? Because high multiples just means you will keep on dominating, and you will keep on growing faster. Like that's what high multiples.
The other way to look at it is that even after being in the sector for 20 years, I mean, I think everybody would agree that Bajaj and ICICI, their premium rates are higher than the other insurance players, even if you compare with the online ones. So even after being in this space for 20 years and probably charging normal return rates, they have this profitability, which is 18% ROEs. Now the others are definitely undercutting. That's why they're not at the same sort of profitability as the ICICIs and Bajajes. So the other way is either ICICI goes down to 15% ROE and takes market share, or the other ways, the others need to increase their pricing if they need to get better ROEs. Now we'll need to see how it actually plays out. But I mean, beyond a point, even say an Edelweiss or SBI, Tata, Star, etc., their shareholders would also want to see some profits or some ROEs at the end of the day. You will put losses for okay 10 years. That's fine. I mean, everybody understands that you will have a long sort of period before you are profitable, but that you also need to look at it in the context that money was available cheaply for a long period of time. Today, that is not the case. I don't know whether it will be the same in the future or not, but today that's not the case. So you would
Uh,
need to have some profitability. So if
okay.
the others, I mean, let's evaluate both the scenarios. Let's assume that the other competitors increase their pricing to be able to get normal profitability. In which case, then you will not really be able to differentiate between an ICICI, Bajaj, or let's say an Edelweiss or a Star, for example, in terms of a customer wanting to buy any of these policy. Right now, I mean, most people would opt for the cheapest auto insurance policy, but that's because the others are not maintaining decent ROEs. If they increase their pricing, then maybe people will pick an ICICI over, let's say, Tata, for example. Now, the other scenario is that, okay, the other players don't reduce their pricing, they stay where they are, which is what is happening. And that's why you'll say that ICICI is getting more active in the health space because they've realized that by sort of maintaining their premiums, they've not gained any market share. And that also explains the 2% lower guidance is that they need to now pay up to set up their health insurance space. So it's possible that the 18 goes to 17, 16, 15. That's possible. But the runway for growth, I would say, is at least 20 years. I mean, you have that visibility for some terminal growth, whereas for a lot of the other sectors, that itself is not visible. And I mean, HDFC Bank for a long time was trading at 5-6 times price to book. So a six there is actually a six in ICICI is actually cheaper than a six in HDFC because in HDFC was diluting money every 5 years, whereas ICICI has not diluted that equity. So, I mean, to be an apples to apples, probably six is comparable to a nine in HDFC. I mean, I'm just making up numbers, but the point is to show that the dilution of equity is not captured in that six.
Ravi, one more thing. You said the combined ratio of 100, right? So does that mean that they don't generate any money on their, underwriting all their, so is pretty much a bet on their float and their investment track record?
That's probably a good way to put it. Is as of now, yes, because I mean, with combined ratios of 100%, they're really not making any money underwriting.
Mm.
And it's as of now, it's basically a float game. I mean, they're making money only on account of float. If you remove the float income from their P&Ls, I mean, they're all in losses. And the
And is that
other
the
important
case?
thing to look at is because since their combined ratios are above 100, the additional float that they will generate is mostly just returns on their investment because there's not much sort of free cash flow left after underwriting.
Okay, oh, that's a good one. Yeah, thank you. And which is most profitable in for underwriting in the peer group?
So if you look at the loss ratio, right, which is the sort of comparison. So I mean, you will need to exclude Star because it's only into health. So I mean, if you divide the sort of four segments into sort of long tail, short tail, right? I mean, see, fire, marine, most insurance companies would, opt for reinsurance because they're like long tail events. I mean, if something one catastrophe can sort of have wide impacts. So most of it, I mean, any sensible insurance company would look at reinsuring. It is motor and health, which are like smaller claims, and typically, I know it's not a good example now because COVID happened, but it's not going to happen. Then suddenly 20% people die, or you have 20% accidents of your policies in a year. I mean, these are more like normal curve distributions where, broadly, these things are similar year to year, excluding COVID. It doesn't, like I said, the example is not very valid because of COVID, but broadly, they are stable businesses. So insurance companies would want to retain a large chunk of the premium for motor and health. And again, in health, it again depends whether it's a group or a retail policy. Now, retail policy, you would have, say, lower loss ratios, which is fair, which is why Star UC's the loss ratios are over here. But then you need to spend a lot of money to get this retail health insurance book, Whereas for a group policy, I mean, your loss ratios would be like 95% or 98%, but you don't have that expense ratio. So it's a combination of both. I mean, it's not a simple answer that if you only do health retail, you're better off, or if you do only do health group, you're better off. So you need to have a mix of both. And ICICI sort of lost out on the retail health space, which is why they are struggling here. And now, I mean, they are sort of very late to the party. You can just see the amount of money they're having to spend just to play catch up. But broadly, if you exclude those differences, I mean, they're broadly all the same. I mean, I wouldn't really say that somebody is a better underwriter than the others. I mean, they're all around the same numbers. I mean, this is probably just because they are newer than ICICI and Bajaj, but eventually they'll also all sort of all converge in that 70-75% ratio bucket.
Thank you. Thank you.
That's why I think HDFC has not gone for IPO as well. They know that they are still not there in terms of stability. Once they are stable, they'll definitely do an IPO.